All right, let's get started. Good afternoon and welcome to today's educational webinar on cash secured puts. My name is Prakash Vijayanath. I'm a senior analyst here at OptionsPlay. And today I'm going to be giving you my thoughts and really going to be talking about cash secured puts and in a bit more detail, seeing what they're really beneficial for, especially as not only an income generating strategy, but also a stock acquisition strategy as well. So, quite a lot to get through. And before we get started, just a quick disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by OptionsPlay or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. All examples are for illustration purposes only, and examples do not include any commissions or fees. So, our agenda for today, we'll be kicking off with actually an overview of the wheel strategy, which is essentially what we are building towards. 2 weeks ago, we covered call strategy. Today, we'll be covering the cash secured put strategy, and combined, they make the wheel strategy. So in the following webinar, we will be going over the wheel strategy in more detail, but it's always important to understand where cash secured puts fit into the bigger wheel strategy. We'll take a deeper dive into the cash secured put basics. I will take a look at an example as well of a cash secured put. We'll look at the optimal cash secured put. So a very important part of today's webinar, finding the correct strike price and expiration date for cash secured puts. We'll take a look at the trade management as well for cash secured puts. So what happens after you open a cash secured put? How do you manage it? When do you roll? When do you close? Or when do you simply allow assignment? And finally, we'll very quickly go over options plays and first trades tools for cash secured puts, not covered calls. That is a typo. I apologize for that. So the main question I want to help you answer today is, how can I invest for the future at a discount using short puts? And the cash secured put strategy allows for this. So before we really get to answer that question, I do want to take a quick look here at the wheel strategy. I know I explained this 2 weeks ago, but for those of you that are new for today's webinar, the wheel strategy is essentially, I would call it the ultimate income generating strategy. It does definitely tick a few boxes. For starters, it does help you create a continuous income stream for your portfolio. It helps you purchase stock at a discount, and it helps you participate in a capital appreciation. Now, when it comes to cash secured puts, it really impacts these two outcomes, creating a continuous income stream, and it allows you to purchase the stock at a discount. And once you purchase that stock at a discount, you get to participate in that capital appreciation. So on the right-hand side, you have a diagram here of what the wheel strategy is essentially. And the first step for the wheel strategy is the cash secured put component. So what is a cash secured put? All a cash secured put is simply selling a put option, so you're short a put option, and when you sell an option, whether it be a put or a call, you collect premium. So that's how cash secured puts immediately create an income stream for your portfolio. And once you sell an option, especially in this case, a put option gives you the obligation to purchase those shares from the option buyer at any time on or before expiration. So by selling a put option, you're essentially the passenger in the strategy. You're not the driver. The driver is the option buyer who decides when he or she wants to exercise his or her right to sell you those 100 shares. And as a put option writer, your obligation is to purchase those 100 shares. But because you have an obligation, and by collecting premium, really two outcomes from here that can happen. What does this mean? Well, when you sell a cash secured put, the strike price will be below the underlying price. You generate premium, and throughout the lifetime of the contract, the underlying value will naturally shift and change and decline or rally. But by expiration, or even around expiration, or let's just go for expiration in this case. At expiration, if the underlying is above the strike price of the put option, the put option essentially expires worthless because there's no intrinsic or extrinsic value, right? There's no intrinsic value because it's not in the money. There's no extrinsic value because there's no time to expiration left. So there's no time value left. And in this case, because the put option expires worthless, nothing really happens. All that you have to do from here is rinse and repeat the strategy to create a continuous income stream, collect more premium, and again sell another by selling another put option. Now, you may be asking, why would I want to do this? Is am I not taking a lot of risk by selling a put option for a small amount of premium, and I might actually end up owning the stock? Well, the motivation for the strategy does revolve around you wanting to own the stock. In fact, that should be your priority. Your priority is to own the stock, but by using cash secured puts, it's a more cost-effective way of acquiring that stock. Because by using the premium that's collected from selling a put option, and by offsetting that against the purchase price of the 100 shares, which will be the strike price, you essentially are purchasing that stock at a discount. That premium will offset the overall cost basis for that stock purchase. And if you rinse and repeat the strategy a few times, the cost basis will decline quite significantly. So when it comes to put options, or cash secured puts, I should say, you always want to sell cash secured puts only on stocks that you are willing to own, which means that you have a long-term bullish view on the stock, but you maybe have a short-term neutral to slightly bearish view, and you think the stock will dip, allowing you to get assigned. Priority for cash secured puts is actually assignment. And that leads us to the second outcome, which is that if you do get assigned, so by expiration, the underlying is below the strike price, you will get assigned and therefore have to purchase 100 shares of the underlying stock. From there, you are long 100 shares and you can start selling covered calls for additional premium. So again, when it comes to cash secured puts, it's very, very important not to sell cash secured puts on stocks that you do not have a long-term bullish view on. You need to be okay with the fact that you will be long 100 shares, probably for the long term. Cash secured puts just allow for using the premium that you collect to offset that initial cost basis, and it allows you to purchase that stock at a discount. Okay, so over here we have our 4 basic strategies. Top half is the bullish strategies, and the bottom half are the bearish strategies. When it comes to cash secured puts, it does mostly correlate to the short put strategy. It's pretty much the same thing, bar one leg. That one leg is that you have to set aside cash as collateral, and that when assignment happens, we will be long 100 shares. But the short put strategy is a bullish strategy / neutral strategy. It's not as bullish as long calls, but it is moderately bullish. And it's not as bullish as long calls because your maximum gain for this strategy is capped to the premium that you receive. And this creates an obligation to purchase 100 shares in the case of assignment. So even though the short puts or naked short puts are really a bullish strategy, when it comes to cash secured puts, because your motivation is different, your motivation is to get assigned, it's actually short-term bearish to neutral. So you get assigned, and then longer-term bullish once you own the underlying stock. So what is a cash covered put or cash secured put? Well, this strategy does require one prerequisite, and that is to have cash readily available to purchase 100 shares of that stock or an ETF that you wish to own. That's the most important thing. It's a stock or an ETF that you wish to own for the long term. From there, you sell a put option, you use that cash as collateral, and by selling a put option, you also receive premium. This creates an obligation to purchase the stock or ETF at a specific price or the strike price. Now, when it comes to this diagram, as you can see, it is still slightly bullish because of the value of the put option. It will value of the put option will decrease when the underlying does rally. And normally, when you are selling a naked put option, that's a good thing. You want the value to decrease so you can buy to close at a lower price, or let it expire worthless above that strike price. But again, just remember, when it comes to a cash secured put, your priority here in this case would be assignment. So you actually don't really care too much about the max gain. The max gain, that represents the premium received, but you do want to get assigned. That is your priority. And when it comes to the break-even price, so usually when you buy stocks, let's say 100 shares, a block of 100 shares, the break-even price, it's because of the symmetrical risk profile, it's the purchase price or the cost basis of that stock. But by using a cash secured put, you're essentially moving the break-even price to the left, or you're lowering that break-even price because the premium that you receive can be used to help fund that cost basis for the 100 shares. So going through a quick example here. So we're comparing here the difference between buying a stock with a limit order and buying the stock using the cash secured put strategy. The goal here is to buy 100 shares of ABC trading at 160, and we have a 175 price target in this example. Now, because we want to purchase it at 160, but ABC is currently trading at 165. So if we place a limit order here, the trade would be to buy 100 shares of ABC at 160, and you'd essentially have to wait for ABC to decline to 150, or sorry, to 160, I should say, and then from there, that trade will become executable. Your risk is 16,000 in total, or 160 per share, because the underlying stock could decline to zero, and your reward is $15 per share because you have a price target of 175, and we assume that you will sell at 175. So that's quite simple to understand. However, when it comes to using a cash secured put strategy, the trade here would be to sell one ABC 160 strike put option, and you receive a premium in doing so, which in this case, for example, is $3.15. Your risk is therefore reduced because that premium that you received is on a per share basis, and you receive $315 in total, and therefore your overall risk has been reduced by $315 from 16,000 to 15,685. Your reward therefore has been increased because, remember, you still want to sell those shares at 175, and because your break even has been reduced, there is more room for this rally to 175, and therefore your reward becomes $18.15 per share, or 1,815 in total. So that premium that you receive, it does shift that break-even point for the strategy. And it's another good way of looking at the strategy is your biggest risk when investing or trading shares especially is the fact that the stock could move to zero, and your break even will always be the average cost basis for the shares. Now, by using income strategies like covered calls, and in this case, cash secured puts, it immediately helps improve your overall risk to reward by reducing your risk and by reducing your break even for the share purchase. Right, so taking a look at the optimal cash secured puts, we have ABC trading at 165. And we have done, the back testing for you. We have tried out different expirations and strike prices over the last, really since 2008 or up until 2022, just to get an idea of what had the best longer term results. And when it comes to the expiration, the most optimal expiration was between 30 to 45 days, but closer towards 30 days. You actually want to be on the closer end to expiration when it comes to this. This is because if you go too short, you don't really generate a lot of premium. But if you go too long with the expiration dates, yes, you generate more premium, but there's more time for the stock to rally as well. And it takes more, and because you have to wait for the put option to essentially all the way up until expiration to see whether you get expired or assigned, it just takes too long. So for 30 days, that's just a sweet spot to help you get assigned. Now, when it comes to the strike price, we have three different strikes. We have the 165 strike, which is a 47 delta. This collects $4.85 of premium, and this represents a raw return of 2.9%. So that's how much of a discount you are getting in terms of the stock purchase, and therefore your break even has been reduced from 165 to 160, just above 160, thanks to the premium that you receive from selling this put option. The 47 delta, we all know what delta means. It's the it's a move of the value of the option contract relative to a $1 move of the underlying. However, when it comes to income strategies, you want to view delta as in a more probability-based approach. So 47 delta tells us that there's a 47% probability that this option will expire in the money, or in other words, there's a 47% probability that ABC will be below 165 by expiration. And that's an important thing to keep note. Now, the next strike price that we have is a 162.50. This collects 390, slightly lower raw return because it collects less premium. And the break even is actually a little bit lower, given the fact that this is a lower strike and you are still collecting some premium. So you actually get the effective break even for the strategy is actually a little bit lower than the 165 strike. And this is a 40 delta, indicating a 40% probability of ABC being below 162.50 at expiration. And finally, we have the 160 strike. So that's quite further below where ABC is currently trading, collects less premium, and therefore less raw return, so less discount on your stock purchase. And the break-even is also lower, given the fact that we have a much lower strike price, but this is a 30 delta. So there's only a 30% probability of you getting signed on this strike price. So using these three strikes, a quick test for you. Tell me which one you think is the most optimal strike price. Is it the 47 delta, 40 delta, or the 30 delta? Please use the chat window. So I'm seeing pretty much a perfect mix of 47, 40, and 30 delta. And I can see why you may want to go for the 30 delta because of the lower break even, but it's always important to remember what your priority is for the cash secured put strategy, and that is to own the stock. So you want to own the stock as soon as possible, because from there, you get to participate in the capital appreciation. And for that reason, the 47 delta is the most optimal, but I would say anywhere between the 40 and the 47 delta. So a general rule of thumb, when it comes to the most optimal cash secured puts, the optimal delta or delta range is between 40 and 50, because this prioritizes capital appreciation. It prioritizes acquisition, which in turn prioritizes capital appreciation. And you're not reliant on the underlying stock to decline too much before getting assigned. Now, there's obviously going to be times where you may want to go for a 30 delta because you think there's going to be a much further decline in ABC, and you don't want to have a higher break even. But under normal or relatively normal trading conditions, the general rule of thumb is between 40 and 50 delta. And also, you have to consider that this collects the most premium as well. Yes, your break even is slightly higher, but it's worth having a slightly higher break even if it means that you will actually own the shares. Because the worst thing about that you can do is maybe go too conservative on your delta and actually never get assigned. And over the long term, ABC just continues to rally and rally and rally. So yes, you could keep selling cash secured puts, but your effective break even when you eventually get assigned will continue to increase over time. So prioritize acquisition and go aggressive with your delta. Between 40 and 50 delta is the most optimal. Right, so when it comes to cash secured put outcomes and management, so we're going with our same example here of ABC currently trading at 165. And the trade here is to sell one ABC 165 strike put option, and we receive $4.85, so just under $5 in terms of premium. And that's on a per share basis, so just under 500 in total. And therefore, this requires just over $16,000 in cash. Remember, you want to subtract 16,500 minus 485 to give you your required cash as collateral. Now, there's really two things that can happen. In the event that ABC rallies and moves above 165 at expiration, The puts simply expire worthless. You get to keep your full premium, which represents a 2.9% discount on your stock purchase price if you had got assigned, but you get to keep your full premium. Yes, you may miss out on some upside, which is really the biggest risk when it comes to the cash secured put strategy. And you would potentially have to sell another put option if you're still willing to buy. And the only thing is that if it does rally significantly, that strike price of the new put option that you sell will be a little bit higher, maybe at 170 or so. So that is the potential downside for not getting assigned right away, is that there is a missed opportunity to immediately acquire the stock. Now, in the event that ABC actually expires below 165 at expiration, in this case, the put option is assigned. You therefore have to purchase 100 shares of ABC at just over $160 per share. And this reflects a 2.9% discount on your stock purchase. So that's after one iteration of the strategy that you already received just under 3%, a 3% discount on your stock purchase, which over 100 shares is quite a significant amount. So using cash covered puts or cash secured puts to buy stocks or an ETF. So the what and when of the strategy, when do you really want to use it? Well, your view should be neutral to slightly bearish in the short term, because you want to get assigned, and therefore to get assigned, the stock would have to slightly decline. But you also want to be bullish in the long term because you now own 100 shares after assignment, and you don't want to own 100 shares of the stock that you do not believe will or has a potential to continue to rally. You have to have cash readily available to purchase those 100 shares of the stock or ETF, and your trade will be to simply sell a put option, which obligates you to purchase the underlying shares at the strike price. And like I mentioned before, that premium is used to offset the effective cost basis for the stock. However, you will not participate in a rally above the strike price or the premium. So what do I mean by that? Well, if you think about it in a different way, let's say you don't get assigned. Let's say you receive, if we go through our previous example here, and you receive $4.85, that means you actually have an effective risk-free range. Let's actually make it simple. Let's say we got $5 instead. Your effective risk-free range is between 170 and 160. So what does this mean? Well, if in the event that ABC at expiration is below 170, yes, you missed out on capital appreciation, as in you could have purchased the 165 and they said 168. There's $3 of capital appreciation that you missed out on, but you received $4. You received $5 already from the premium received. So you still have effectively participated in the capital appreciation via the premium received. Now, if we look at the downside, let's say ABC declines to 161, and your risk-free range, the bottom part of the risk-free range is at 160. All that means is if it breaks below 160, that's when you start to incur losses because you're still purchasing it at 165. So that $5 in premium that you receive also acts as a downside buffer so ABC can decline a little bit more, and you can still be immediately profitable even after assignment. It's only when it declines below 160 where the premium received doesn't fully cancel out the decline in the stock, because the decline is more than the premium received. So that's what I'm talking about when I'm looking at the risk-free range of the cash secured put strategy. It has to do with the premium the premium plus the strike to the upside, the strike minus the premium to the downside. It's not too important, especially to the downside. Even if ABC were to, let's say, decline below 160, if you still have a long-term bullish view, it's not, you don't necessarily want to not be assigned those shares. But in terms of immediate profitability, the risk-free range is above 160 and below 170 in this specific example. Okay, when it comes to the setup and some tips, we're really looking at the optimal cash secured put. Expiration is 30 to 45 days to expiration, but really target more the 30 days to expiration. Strike price, you are going slightly out of the money to at the money, so the delta would be 40 to 45. It says 45 to 50 here, but even 40 to 45 delta is completely okay. And it's terms of an expert tip, IB rank of greater than 50. So what does this mean? Well, because implied volatility takes a huge part in the options pricing formula, high implied volatility on the stock indicates that the options on a stock over a specific time period will be a lot more expensive relative to usual conditions. So all this means is that you're getting more bang for your buck by having a high IB rank, but it's not necessarily a determining factor on whether you want to own the underlying shares. So if we go through a quick example here, our same example, if the stock is at 165, we sell one put option, 30 days to expiration with a strike price of 165 and receive $5 in premium. In this case, we are obligated to purchase that stock at 165 per share. However, remember, your effective cost basis or your effective break even is actually 160 because of the $5 premium acting as a buffer. Your max gain is simply $5 a share until you get assigned, because you won't be able to earn more than the premium that you receive. Your max loss is $160 a share in the event that ABC happens to decline to zero. And like I mentioned earlier, your risk-free range is 160 to 170. So if ABC rallies above 165, you're not missing out on that rally until it rallies past 170. And if it declines below 165, you're not incurring any immediate losses after you get assigned, unless it declines below 160. A cash secured put. So taking profits, you want to do that at around 75% of the premium that you receive. So what does this mean? Well, let's go through it. Our same example. You want to take profits when this put option is worth $1.25, because that is the remaining 25% of the value of the option when you initially sold it for $5 premium. So how does this happen? Well, when you sell a put option's value will decline if the stock either stays neutral or rallies a little bit higher. And because of the stock rallying higher, your probability of getting assigned becomes lower and lower. And therefore, it might be a good idea to be taking profits on the on the put option component of the strategy, because you know you're not going to get assigned anyway, and your short put position is still in a profitable position. So why do we say you'd want to take profits at around 75% of the premium received? It's simply because, yes, we do see an acceleration in data decay closer to expiration, but there's so little extrinsic value to extract close to expiration that if the stock has already rallied, you'd have to wait, maybe a week or two to really realize the remaining $1.25 in this specific example. So a put option will depreciate in value if the stock stays neutral or moves higher, and that might be a good thing in terms of your P&L for the put option in isolation, but it means that you also won't be getting assigned, and it also means that you may want to roll or evaluate your position, and when you roll your position, you do have to close out the put option. So it's not necessarily a very negative outcome, but because your priority is to get assigned, a rally, even though it's profitable for the put option, again, you much prefer a short-term decline in the stock, and so you can actually get assigned as opposed to actually taking profits on this put option component. You want to take a loss at around 100% of the premium received. So at 165, and let's say with 165 strike and at expiration, in this example, because you sold it for $5 worth of premium, when this becomes worth $10 at expiration, or when at expiration the underlying is trading at 155, that's when you'd want to actually simply cut losses on your trade. But you can really do two things with this, right? So you can either buy to close for $10, you sold to open for $5, buy to close for $10. That reflects a $5 loss per share, or 500 in total, which is quite hefty. Or you could do what you simply set out to do in the first place and simply allow assignment if you are still bullish on a strategy. And that's the key thing. You only want to allow assignments if you are still bullish. If it's made a significant decline very quickly, your bullish view may change to a more bearish view. And in that case, that's when you want to buy to close out this put option for a loss and take the loss. Whereas if you're still bullish on the stock, in that case, you would simply allow assignment, and this cash secured put would have effectively done its job. You'd want to consider rolling the trade at around 14 to 21 days to expiration, or more specifically, if the rally of ABC is greater than the premium plus the strike price. So like we said, there's a risk-free range, and the upper bound of the risk-free range is 170. So if ABC rallies from 165 or above 170, that's when you'd want to consider rolling. And that simply means buying out this short put, which would be worth very little, and immediately selling to open another short put using the same best practices of around 30 days to expiration and around a 40 to 50 delta. And therefore you generate more premium, but your break-even price or your purchase price of the stock will be a little bit higher as well. Or you can simply just evaluate it. Maybe you'd want to wait for a bigger decline in the stock before looking to sell another cash secured put. Right, and finally, options play with, in partnership with First Trade, we do have a short put report available for you, and this report does scan all S&P 500 stocks as well as very liquid ETFs. It's updated every hour and helps you find optimal opportunities with the highest yield. So it is by default sorted by raw return, but this report essentially allows you to help maybe generate some ideas. So if you were to cycle down the report and, if you were to see, let me just try get an example here. Go. So we have the short put report here, and as you can see, it has a whole bunch of ideas. Obviously, this isn't a scanning tool for long or for bullish positions that you want to take a look at. The way you'd want to look at it is, okay, simply go through the list, and if there's a name that you are familiar with that you think that you want to purchase 100 shares on, for example, Lyft, maybe you have a long-term bullish view on Lyft. You could look at this report helps you find the most optimal cash secured put for that. It can help you acquire the stock at a discount. So in this case for Lyft, the most optimal cash secured put has an expiration at midway through November 17th. The strike price is at $10 a share, and the mid price is at 0.86. So the mid price is simply the middle price between the bid and the ask, and it represents the most competitive price that you could get filled at. It does tell you the IV rank, but again, when it comes to the IV rank, it's not a determining factor. It's just a nice to know. That's how I would use it. We also have an earnings date and an earnings flag. So an earnings flag would be yes, if there's an earnings date within the lifetime of this contract. And in this case, Lyft does have earnings on November 8th. So it might be something that you want to be aware of. It is a high volatility event. And it gives you other information such as the raw return. So how much of a discount you'd be getting on your purchase price by utilizing this cash secured put, which in this case would be around 8.4%, and an annualized return. The annualized return represents this, if you did this cash secured put, you repeated it every, let's say 30 days, if it's a 30 day to expiration, every 30 days for a 1 year period, the premium that you would have received, all else equal, would be just over 100%, indicating that you would have effectively covered the full purchase price of Lyft. Obviously, things will change because Lyft could rally. It's not like Lyft will simply stay neutral for a 1 year period, but this annualized return is based on the assumption that all these other metrics are equal and you're rinse and repeating the strategy for a 1 year period. And also has the distance to strike. So it tells us how much the stock needs to decline for you to get assigned. So a very helpful column. So yeah, I mean, when it comes to cash secured puts, this report does make life a little bit easier, but don't simply use it don't simply decide that you want to buy a cash or sell a cash secured put because you see a stock at the very top of this report. This should be more used as, a search feature where if there is some stock that you've done a lot of research and you've done your due diligence and you are interested in a long-term bullish opportunity, this is where you'd want to utilize this report. Okay, so with that, I'm going to open the floor to any questions that you may have. So please use the Q&A window for that. Thank you. For some reason, the Zoom meeting controls has disappeared. 1 second. Actually, if you don't mind, you use a chat window instead, because for some reason I cannot see the Zoom meeting controls. Thank you. Yep, I see a test message there. I know there's a shortcut, but not sure. Okay, there we go. I got it now. So you can use the Q&A or the chat. Apologies for that. As you know, now interest rate is high, so we can earn around 5%, risk-free. Yeah. Is it good timing to use cash secured puts? I would still argue that given the fact that the cash secured puts is a long-term bullish strategy, you don't want to factor in interest rates too much into your decision. And because, in a year's time, we could see interest rates fall quite drastically. A lot can happen in a 1 year period, and that would be still a short time frame when you're looking at a long-term bullish strategy, especially when you are owning the stock. So yes, it's a good thing to think about that, but I wouldn't factor that in too much into your decision making. I think the most important thing is that the stock, you think that the stock will perform well. You think it'll perform at a higher rate than 5% per year, which is the risk-free rate. And in that case, by all means, use the cash secured put is still a good strategy to use to obtain the underlying stock. Okay, there are no more questions. Thank you all for joining me today. Hope you learned something about cash secured puts, and I will see you next week Tuesday for another webinar, another Tuesday Market Outlook webinar.